Hello everyone, welcome to a short lesson video on business purchase and merger for Cambridge A-level accounting. Before we proceed, please note, abbreviations are used in this presentation only due to space constraints. Abbreviations are strictly not allowed in the Cambridge exams. Let us understand the difference between the concepts of business purchase and business merger. Suppose there are two businesses, A and B. They are independent, separate businesses and they decide to combine their assets and form a completely new business C. This is called business merger. On the other hand, if there are two separate businesses, business A and B, and business B buys business A, as a result of which business A is closed, it shuts down, it ceases to exist, and it results in a bigger company B, this is called a purchase. Any one of these four types of questions can be asked in the Cambridge A-level exams. So you could be asked merger of sole trader and partnership business, or purchase of sole trader by a limited company, or purchase of a partnership by a limited company, or the merger of sole traders to form a partnership. We will look at each of these types in detail. Whenever we buy something, we need to pay for it. The price paid by the purchasing company to the selling company is called the purchase consideration. Purchase consideration can be paid in either cash or shares of the purchasing business or debentures of the purchasing business or any combination of these. We must now understand a very important concept, that is net assets taken over at fair value. First, we must understand what is the meaning of net assets. Net assets is another name for capital. And what is capital? Assets minus liabilities. Therefore, net assets taken over means assets taken over minus liabilities taken over. Whose assets and liabilities are being taken over? The assets and liabilities of the selling business. So what is meant by the term fair value? Fair value means the values of the assets and liabilities taken over as agreed between the buying and selling parties. There could be reasons for disagreement at the time of business purchase or merger between the buyer and the seller. The purchaser might feel that the depreciation provided by the selling business had been inadequate, and therefore the book values of the assets of the seller are greater than should be. It could be that the purchaser feels that the seller had failed to provide for an impairment loss. Again, this would lead to an inflation of the book value of the seller's assets. The seller might feel that the purchasing business has undervalued it during negotiations. So these are problems that might arise at the time of business purchase and merger regarding the asset valuation. And the solution for this is to get the assets of the seller revalued by a professional valuer. The revalued figures will be the fair values as agreed between the buyer and the seller. Now we must understand the concept of goodwill. The formula for goodwill is purchase consideration minus net assets taken over at fair value. What is purchase consideration? It is the amount that the purchaser pays. And what is net assets taken over at fair value? Whatever the purchaser got. The purchaser is paying something extra for the net assets of the selling business, and this something extra is called goodwill. Thus, goodwill is the amount paid for the acquisition of a business in excess of the fair value of its separable net assets. The term separable here means that the assets can be sold separately and the liabilities of the selling business can be settled separately, individually. So why is the purchaser ready to pay something extra to the selling business? The seller could have a really profitable business, and the purchaser will benefit from this already established business. He does not have to build the business from scratch. Or the seller's premises could be in a really good location. Or the seller has a really strong and loyal customer base. Or the seller has a really good reputation in the market from which the purchaser will now benefit. Or it could be that the seller's employees are very well trained and efficient, so it means less costs for the purchaser. Let us now solve a simple sum on the calculation of goodwill. The directors of B Limited have decided to purchase the business of Alex on 1st May 2021, and the statement of financial position of Alex before the purchase has been provided to us. B Limited has agreed to pay a purchase consideration of $60,000 in cash. All assets and liabilities except cash will be taken over by B Limited. And then they have provided to us the revalued figures for assets taken over, that is machinery and inventory. We now have to find out the value of goodwill. We know that the formula for goodwill is purchase consideration minus net assets taken over at fair value. That is purchase consideration minus net assets means what? Assets minus liabilities taken over at fair value. We know that B Limited has agreed to pay a purchase consideration of $60,000 in cash. Therefore, our PC purchase consideration is $60,000. Now we must find out the revalued amounts for assets and liabilities that have been taken over. All the assets and liabilities except cash will be taken over, and the revalued amounts of machinery inventory are 30,000 and 10,000 respectively. Other than that, we don't have any other asset which has been taken over. Also, there is one liability that has been taken over, trade payables, and that is taken over at book value. So let us now record the assets and liabilities taken over at fair value. 30,000 of machinery plus 10,000 of inventory minus liabilities of $5,000. That is 60,000 minus 35,000, which gives us a total goodwill of $25,000. A common mistake is that students take the assets and liabilities at book values instead of the fair values, so you must be careful. So that was a short introduction of the chapter Business Purchase and Merger. We will solve a past paper question in the next video.